Welcome to TheoTrade. This is Don Kaufman. It's May 2nd, 2025. Just about 30 minutes to go to the cash close here on this Friday afternoon. The S&Ps once again ripping to the upside. Now look at this. The SPX up somewhat. 90 plus handles here on this Friday. You know, one of the statistics I'm going to throw out just right off the bat. We are looking right now at literally 10 consecutive up days in the S&Ps. You know what? The last time that actually happened was all the way back in 2004. So some pretty wild upside activity in this marketplace. Again, I'm stating statistics right off the bat, relating all the way back to 2004. And look, you know, this rally is real, but don't get too comfortable. And that is exactly what we're going to continue to explain here, of course, on this TheoTrade weekend update. Look, I'm not trying to make large bearish connotations right off the bat, but I think everybody needs to be aware. You're a tweet away, okay, from 200-300 point moves inside of the S&Ps. And what we're going to substantiate here is that, yeah, volatility has made a meaningful move to the downside, but we're not sounding the all clear by any stretch of the imagination. I continue to reiterate that. Okay, I'm also going to display to you, look, if you want to be bullish, you want to be bearish, and that's fine. I'm actually going to give you some directional bias in here, but if you are going to be bullish, okay, use spreads, mitigate risk, and I'm going to continue to show exactly how to do that. Let's get to work here, of course, on this TheoTrade weekend update. You know, the first thing to look at is the S&Ps this morning popped to the upside. Originally, it was the jobs number. I'm going to talk more about the jobs in just a moment. The jobs number pops us to the upside, but then there was actually a tweet. Okay, we got tweeted upon. A tweet, a news announcement, whatever it is. It was actually China. Okay, so we make this, solid, a meaningful move to the upside. But here's the real reality. The entire move to the upside was just about hitting the upper edge of the expected move in the SPX. We're home. Yeah, right now we're outside the expected move, but by a fractional margin. I mean, for the most part, like when I put this into context, you're like what, 20 points outside the upper edge of the expected move, which is again almost like a rounding error in here. It's a $5,700 product, and we're splitting hairs over that. But the entire trading day, look, we just popped to the upper edge of the expected move, did a little dance, made a little love, got down tonight. That's pretty much a trading session in a nutshell. Who cares what we did in the past? Let's talk about the future. Okay, and in the future, one of the first things you have to look at is, volatility. It did make today a meaningful decline. And one thing I want to point out is throughout the course of this week, volatility really was not backing off. And yeah, I'm looking at the VIX right now, but to be quite frank, guys, I like to look at the volatility futures. This is a tradable, tangible product. And the volatility futures are 1, 2, 3, 4. They had 5 trading sessions. They did not budge. And again, I really want to zoom into this, okay? Because this is where people are like, it's going to be okay. It's going to be okay. Today is the first time, truly the first time that we made a meaningful decline in volatility. But at the exact same time that I'm saying that, and it's, this weekend update here is, the rally is real, but don't get comfortable. Why should you not get comfortable? Because we're still, okay, in a technical backwardation, right? I mean, this is still red flags, warning bells, ding, 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 whatever the hell you want to call it. You should recognize, okay, and have a bit of respect for the fact that volatility is still, it's not normalized. And in just my opinion, it's not gonna normalize until we're through the big deal with China, which it's impossible to kind of handicap what that's gonna look like. And well, we're going to talk exactly about that too, because I think it's important. Like, again, people have a lot of misconceptions about what this might look like. So volatility has made a meaningful decline. I'm going to give you that. And in fact, you can even look at VVIX, look at every volatility indicator, okay? And they've come off, and they've come off quite considerably, even the VVIX. But the first to tell you, like, whoa, look, You know, this thing has really dropped 97, but we're still, what I would term far from normal. A lot of people could be described as far from normal, but the volatility, okay, it has not completely normalized, and that's why I'm saying don't get too comfortable. The other, aspect, and this one is not nearly as quantifiable, if you will, but in the past, I've been pretty good at actually handicapping some of the moves, okay, from other sovereignties and so forth. And look, I'm just going to give you a little opinion piece over here. China, okay, whatever you might think about this deal that's going to be cut, China's not actually going to, roll the red carpet out and make this easy for anybody. And as I said in my note over here, China, they may tweet all over you. You are literally, and as I said this a moment ago, you're a tweet away, okay, from them putting up a fight. And quite frankly, they have to put up a fight. They're not going to roll over and just make this deal easy. It's just simply not going to work the way that people think it is. Unless the US makes massive concessions, okay, which I have a tough time believing. And it's, again, there's a lot of personality involved over here. Is that an understatement, right? There's a lot of personality that's going to be involved in putting this deal together. And by the way, I'm being very soft by saying personality and not throwing a humongous ego into that conversation. But that ego is on both sides. Okay, the Communist Party. Okay, you have the Trump administration. Crap's going to hit the fan. Period. That is my take. So when I say China may tweet all over you, okay, and I say, oh, 300-400 point move, one of the moves that actually occurred today was right here. The other move that occurred where China basically, indicated like, cool, like, let's start, let's talk, baby. That was actually the original move to the upside. And when I'm talking about a few hundred points, what, 70, 80 points, all they basically said is, yeah, we'll approach the table. We'll start to negotiate. That does not include any real negotiations. And of course, there was another message that came out over here, as I was pointing out moments ago, and this was about the beginnings, if you will, of some of the negotiations. So right now, a lot of posturing, no real deal in place. But look, I would rather spend time discussing that and the risk in that, okay, than looking at the S&P prices right now. Because you look at the S&P till you're blue in the face. Where are we right now? We're right back where we started before all the tariff talk, actually kicked in. But at the exact same time, if you're not aware, the real tariffs to all of us just kicked in last night. You're like, what are you talking about? Yeah, on Friday, May 2nd. Okay, small packages. The crap from Temu. Yeah, it's all crap from Temu, but I know one of you bought something good on there, okay? But anyway, the crap from like Temu, most of your Amazon purchases, okay, Alibaba, prices are going to double. It's over double. It's 145%. Now you're actually going to start to feel the impact. And the irony is that that is not necessarily priced in over here, okay? Main Street pain ain't priced in over here. What you have priced in over here, and the reason I'm not spending a lot of time on price action in the marketplace, priced in over here is a hell of a lot of hopium, okay? A hell of a lot of like, look, this deal is going to get done one way or the other, okay? I agree. The deal will get done one way or the other. The problem is it's the other, and the other is not going to be, okay, a nice, easy path, if you will, to get that deal done. This could be months, okay, in the making, but unequivocally, I think we're going to get some wild tweets in there. Now, all other risks feel like they have fallen by the wayside. And I want to make this point too. Jobs number came out this morning. Let's go back to the S&Ps for a second. So the jobs number came out, and it came out right here, okay? 5:30 in the morning Pacific time. What did the market do? They like me. They really, really like me. So you have this approximately 20, 25 point move up inside of the S&Ps. But the interesting thing is, and again, let's not detail the jobs number all that much. The jobs number was better than expected, okay? But isn't like good jobs indicating a bad Fed? Meaning that, okay, if the jobs number is good and GDP is just a function of the tariffs that were coming, okay, it's tough right now for the Fed to make an argument to do what? Okay, obviously to cut. Moreover, this week we actually had data that showed inflation is not dead. And of course, the argument there is like, that data is because of the tariffs, and prices were getting crazy because of the tariffs. I get it. But you have to understand that all of a sudden, the market emphasis, nobody cares about the Fed. Speaking of the Fed, let's actually look specifically at it. So there's a Fed announcement. It's next week. Okay. What is going to happen at the Fed announcement next week? There's a 99.5% probability, okay, that we're going to do nothing. The current target rate is what we term 425, 450. Okay. That's the target rate. And they're assigning a 99% probability, okay, and I'm just scrolling through here, a 99% probability that the Fed is going to do nothing. But that doesn't mean that the Fed is going to not impact the market, because the Fed could actually turn around and go double down dove, right? But what's so interesting about this, okay, isn't the May, it's the June. Actually a huge move in the June contract. So again, here's the 425, 450. Now there's a 63% chance, okay, that we're going to do what? Not cut in June. And the reason I'm actually detailing this is just the other days, okay, a couple of days ago in here, if I actually bring this up, and we'll highlight right in here, there was upwards of almost a 60% chance, okay, of, cuts. So here's the current rate. And again, just a few trading sessions ago, just to kind of delineate what we're looking at. Here's the current rate, okay? There's a 63% chance right now, okay, of doing what? Not cutting. And just, again, just days ago, they were pricing in an interest rate cut. And what's so interesting about that is the marketplace right now, they don't care. They literally, what I'm telling you is they don't care. How could the S&Ps be up 90 points, okay, but the chances of a rate cut have actually gone where? Down. The probability of a rate cut has actually gone down quite considerably. The first time that we're really now pricing in the probability of a cut is going to be in the July, okay, in the July timeframe. So anyway, I thought that was interesting because all that you've heard, okay, for weeks and months, the Fed's got to cut, the Fed's got to cut, even in the administration, the Fed's got to cut. Now, actually, they're pricing in no cut, and the marketplace is still rallying. So it's one of the reasons I'm like, okay, now I'm really like, I see the rally, and the rally is real, but I'm less comfortable at that point, okay? And I'm going to further that with, have you looked at the bonds lately, okay? The bonds are actually selling back off a little bit, which is actually taking what we term the 10-year, and I like to look at the 10-year. Although I pull up the ZB all the time, I like to look at the 10-year interest rate. 10-year interest rate, though, in the last two sessions is ripping again. Okay, so this 10-year could actually rip, maybe get all the way back to like, that's 45, by the way, is 4.5%. Okay, that put a little pain back into the marketplace. So all of a sudden, the bonds, okay, which kind of fell by the wayside, you kind of feel like nobody's thinking about the bonds. Okay, nobody's thinking about the bonds. Forget about the Fed. No, nobody cares about the Fed. You should start caring about the bonds, because if they continue to see some sell-side activity, you better believe higher interest rates is not going to be good. We have higher interest rates. We have 145% tariff, okay, on anything imported from China. Oh yeah, this is lovely, lovely. And okay, even Apple kind of delineated like, no, this is actually hurting, and there's a slowdown over here. But it's almost like everything got smoothed over. Even inside of Nvidia, which is clearly getting their market share eaten right now. Don't worry, it's going to be okay. Take a look at Nvidia, okay? Just in the last like 2 weeks of trade, this thing was down like 30%. It's only down like 17%. It's a straight shot of almost 15% back to the upside over here. In fact, Nvidia, okay, cracking the upper edge of the expected move last week and almost hitting it again this week. So getting a little unruly to the upside. Again, what I'm trying to actually display in here, maybe you can kind of figure this out, is there is a whole lot of bullish hubris, okay, going on in this marketplace, but maybe it's just that, okay, less about the bullishness, more about the hubris. There's a whole lot of ego in this tape right now on this bounce back. And the interesting thing about the rip back, and maybe you guys have actually heard this, maybe not, okay, it's a huge amount of retail trade. I'm actually bringing up right now, this is kind of ironic, I never bring this up, it's the Vanguard S&P 500 ETF, because Vanguard themselves said they had one of the largest inflows of capital in the history of this product, okay, which is a retail-based product. Like retail is just buying up like the S&P 500 like it's going out of style. Um, and this is not about smart money, dumb money. I hate those terms. I actually think retail is incredibly smart. What I don't like though is there's just so much risk in doing it. Look, if you're gonna be bullish, and I'm cool with that, use spreads. And what I mean by that, we're like use spreads because let's just continue to mitigate risk. Use spreads. If you want to get bullish and you're bullish this next week, like don't get crazy. Just go out some 7 days, okay? Buy a freaking spread. Just close your eyes and buy a spread and see where we are at the end of the week. Okay. And if we're higher, okay, beautiful. I'm just showing you like a $5 wide spread or something like that. Beautiful if we're higher. Okay. And you know what? You can make the spreads even wider than that. Like, let's get crazy. If you're wildly bullish, come in here and buy like a 570, come all the way out here to like the 580. Look, anything to mitigate some exposure. This trade still has huge upside, right? $7 and change of upside over here, whatever. Okay. It doesn't, that's secondary. It's the mitigation of exposure. It's offsetting some of the volatility risk that is still really prevalent in this marketplace. And whether you got $6 or $7 of upside potential, look, you could just tweak that to whichever spread you want. And then if you make money 7 days out, what do? You just roll it and do it again, do it again. But the point I'm trying to make over here is I'm not comfortable wanting to be long or short S&Ps. And I'm making that point because, again, just because I'm saying, the rally is real, but don't get comfortable, I'm not trying to put this huge bearish connotation out there. I'm the first to actually tell you it's definitely some two-sided, markets still, even though there has been incredible, one-sided move. Okay, this marketplace is going to take you for a ride. It's only a matter of time before you get that one little blip in the radar. You're like, bam, right back down to 520, and you don't want to get caught in that crossfire. Okay, with anything other than a defined risk strategy, stop orders and so forth. Please, you're going to get gapped. You're going to get taken apart. The one thing markets are really good at is systematically taking people apart in the midst of volatility. Quite frankly, again, you feel like you've kind of normalized. This is like literally on this Friday afternoon, looking at the S&Ps, this is where a lot of people are probably like resting easy and they're like, we're back, baby. Okay. You're not back and you're still at risk. You need to mitigate exposure. And that's probably the biggest takeaway from this weekend's update over here. Many of you that are actually following some of the trades I'm doing here at TheoTrade, okay, I'm just substantiating trades by taking shots. I'm taking like low probability, high payout shots. And what I mean by that is I don't mind showing you, I actually did an SPX butterfly this week for the lower edge of the expected move. I totally missed, but I lost like $45. Okay. So it was 45 cents for a contract on the SPX on the edge of the expected move. And like, yeah, I'm actually talking about a losing trade because, it's thrilling. Oh, I missed it. Okay. Oh no, don't worry. I'll get it again next week. I'm taking like these shots. And the reason I'm taking shots is I don't want to substantiate a lot of risk. Okay. Based on some crazy, Twitter account, based on the Communist Party of Twitter. Okay. Can't call it Twitter account anymore. It's X. I'm very sorry for that. Okay. But based on, whatever negotiations may or may not actually grip hold next week, again, you have a marketplace that literally it's forgotten about the bonds. Okay, it's forgotten about even earnings because most of these companies are actually like retracting their statements too. They're like, yeah, we don't really have any future guidance. They're pulling guidance and so forth. Doesn't matter. Market just stares, smiles, and keeps going higher because the assumption is it's all going to be all right. Okay, and it will. But in the near term, you may still have to actually pass through hell in a handbasket. With that, let's come back to the SPX. Yeah, that's some uplifting conversation. Let's come back to the SPX. As I said earlier, we're home. We hit the upper edge of the expected move. I wouldn't read too much to the fact that we're outside. We're outside by like 15 points right now. All we basically did is come up here, did a little dance, made a little love, again, get down tonight. Like maybe we even come back to this upper edge. So even though we've had this immense move higher, okay, it's unruly, right? But at the same exact time I'm saying that, you realize we did exactly what we're expected to do this week, like to a T. And you know what? As we come closer to the close, you can see the S&Ps, they're going to pull back right to it. They're just going to land on it and it's just going to torture me. And you know why it's going to be torture? Because I did the put butterfly instead of the call butterfly. And I could have done the call butterfly. I could have been somebody, but I didn't. Okay. But that's the kind of shots you want to take in this marketplace. Anyway, with that being said, we're coming off 100 basically and $50 expected move. What are we looking at next week? And now remember, next week has a Fed meeting. You look 7 days out, they did drop the volatility, right? And that's important because, as I said, it's the first time that we've made any real meaningful decline, okay, in the volatility. And I'm going to say this, and I want you to hear it. 127 points. Holy crap, that doesn't seem like a lot. Even though the volatility declined 127 points, okay, how many trading sessions this week did we see the market move over 127 points? Okay, I mean, we almost hit that today. But if you actually looked at literally the overnight trade, take a look. We traded from 5,600 to 5,724. Huh? Yeah, what's 123 points amongst friends? Okay, that was today. You actually had a jump yesterday and then we faded a little bit. You had all kinds of wild movement over here. 127 points. I'm going to tell you right now, I wouldn't be selling any options premium in the short duration over here with only $127 or $128 expected move. Okay. People, keep your hands and feet inside of the vehicle at all times. Okay. Regardless of whatever you might think about markets, stop thinking. Okay. What do you know? You know the risk is not necessarily off the table. Okay. You know that they're going to put up a fight, and you make up your own mind on that one, though, regarding China and several of the other sovereignties. I'm focusing on China because that's the big, tamale. That's the 800-pound gorilla in the room that you're going to have to go through. But literally, you don't want to put yourself at risk and put a tweet away and being a tweet away from like a 200 or 300 point move inside of the S&Ps, because at that point, okay, crap's going to get real. Define your risk, mitigate your exposure. Again, the rally's real. Just don't get too comfortable. Thanks everybody for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.